Hello everyone, this is Professor Kent, and today's recording is Chapter 7, Cash and Accounts Receivable. When we talk about cash and accounts receivable, cash is, of course, management's responsibility is to safeguard all the assets. However, the cash is the most important asset that we need to safeguard as a management or as a company. So in this is what first we're going to do is we're going to talk about the key issue relating to management and control of cash. Now the first one is the main issue is minimizing idle cash. You want to have a little as possible cash that is sitting as an idle. So of course you have a cash, you want to generate more money from the cash that you have. If the money is sitting there is not generating any interest or any other type of income, that's an idle cash. The management's also responsibility is to create to prepare cash flow budgets. So we wanted to know whatever we budget, are we on the right track? Now, for internal control purposes, the management have to make sure the regular bank reconciliation is done. Why is it important? We wanted to know what we have in our GL account is the same money sitting in our bank account. So bank reconciliation, it doesn't matter how many accounts the company has, they have to prepare monthly bank reconciliation. The next key issue relates to this chapter is accounts receivable. Accounts receivable, what are some of the issues that are relating to accounts receivable is a collectibility. The second one is credit policy. Collectibility is, are you collecting your accounts receivable within the time that you said you will collect? Are you collecting your receivables in 30 days, 60 days, 90 days, or 180 days? Those are some of the examples of our credit, of your collectibility. Credit policies, is your policies are lenient, means are you providing a lot of are you is it you're making your customers pay you within 90 days or 180 days depending on it? Are you providing, is your policies are strong policies, or is this very not strong? So they need, those are the issues the management has to deal with it. They also have to look at your accounts receivable levels. When we think of a levels, you have a lot of money sitting in accounts receivable that is not collected yet. If it's not collected yet, what you wanted to do is you want to provide these customers some discount, so they pay you before they pay you on time, or they pay you within 10 days. You wanted to provide them a discount to so that the collection is the collection process is taken care of. So of course the money you have it in the accounts receivable, you want to collect it faster as possible. What is a financial asset? So what is a financial asset? Financial asset is any asset that is a cash, a contractual right to receive cash, or another financial asset from another party. When we think of it, any the right to receive a cash, the perfect example is if you have an inventory inventory sitting in your balance sheet, that means you can sell that inventory, and if you sell that, what you're going to do is you're going to receive a cash. So that is called a financial asset. Accounts receivable, also called the financial assets. We're going to talk about that later on, that how you can sell your accounts receivable to make money. So we're going to talk about that later. So now the other thing we're looking at when we're talking about financial asset is contractual right to exchange financial instrument with another party under conditions that are potentially favorable to the entity. So what you wanted to do is maybe you have an asset and you wanted to exchange that asset with another company, and vice versa. So there's always some conditions. An equity instrument of another entity is also a financial asset. Means what you're doing is you bought an investment, you had a cash, the company had a cash. What they did is they put in an investment into another company, and they did it with an equity investment. Chapter 9 we're going to talk about more into when you invest into other companies. First thing we're going to do is, what is a cash? Cash is considered to be a current asset if it is readily available to pay current obligation and free of restrictions. So any cash that has restrictions, that is not free and you cannot use it. That means it's not available for you. Cash also consists, of course, money. Coins are money, currency, any bills or available funds on deposit at a bank and in a petty cash. They all are cash. Anything that is a cash or converted into cash is a cash. It also includes money orders, certified checks, cashier's checks, personal checks, bank drafts, and usually your savings account. Because savings account, there's no limits on the savings account. You can easily access your savings account. Going further with what is a cash, now we have a cash and cash equivalent. Cash is the cash money what you have in your savings account, like we talk about in money orders, personal checks, bank drafts. Those are that. When we think of a cash equivalent, they're not cash, but they are equivalent to cash. Means they can be any GIC that can be converted. There's no restriction. Means it's not locked in. If it's not locked in, that can be converted into cash. That is called cash equivalent. Post-dated checks and travel advances are not classified as cash. Why they're not classified as cash? Because if somebody gives you money and it's a check and it is a post-dated check, you cannot take it, you cannot deposit into the bank till that date. So that means that's why it is not classified as cash. Also, travel advances that you have given it to, you bought it as a prepaid expenses, those are not a cash. Now, when you report your cash, you have to there's a guidelines when you were reporting a cash on our financial statements. Now, when we think of a petty cash, special payroll, dividend account, they are all kept separately. If the restricted cash balance is material, it must be segregated from the regular cash. So now when we think of what we mean by restricted is the purpose of that cash is only used for that purpose. It's restricted for that purpose. If it's restricted, you can only use that cash for that purpose. So now you put it in a cash aside to develop a building or some kind of restrictor for that purpose. So then you cannot use that cash because you put aside that money for that purpose, so that you can only use it for that purpose. And now cash classified as a current or non-current depending on the availability or expected disbursement. So if you're going to develop this building within a year, then it will be a current asset. If this is going to be done over 3 years of a time or 4 years of a time, then it becomes a non-current. So that's what we mean. Now, compensate restricted cash is, under restricted cash, you have a compensating balance. What we're doing is, when you have a bank account, a part of when you file an application for your bank account, you need to keep a compensating balance. Means part of the account restriction is that you need to keep a minimum balance. So in a minimum cash balance maintained by a corporation in support of existing borrowing. So if you need to keep a minimum cash balance, that is restricted, means you can't use it. So some accounts, they said that you have to keep a minimum balance of 5,000, 2,000, depending on the corporation and depending on your account. And this compensating balance is not available for use by the corporation, but the bank can use the restricted cash. Legally restricted balance must be reported separately under current or long-term assets. We already talked about that before. Now, you could have a money in the foreign currencies. Some companies, what they do is, they don't have if it's a Canadian bank, they also have a US account. So in other words, if you have a US bank account, what you have to do is, on your financial statement, what you have to do is convert that currency into a Canadian dollar and report that on your statement on your statements. The exchange rate on the date. Now when you're converting it, so if you have a US account, so what you have a US account and there's a money, so for example, if the company has $1 million in the US account, so what they needed to do is they needed to convert that money, US money, into a Canadian dollars, and then report that report that onto their financial statements. Now when they're reporting, what exchange rate should they use? So the exchange rate, they're going to use it on when they're preparing their statement. So in this case, if your statement date is December 31st, you're going to look at the exchange rate on December 31st, whatever the rate is. If it's a $1.25 is the rate, or $1.30, so on December 31st, that's when your statement date is. If that's the date, so you're going to look at it, and you're going to look at what is the rate. You're going to convert this US into that rate, and then report that on your financial statement of financial position. If restrictor exists on the foreign funds, same thing, you have a foreign fund. If there's any restriction, you have to report that separately, just like your normal cash. Going further, bank overdraft. Now if you took out more money than you have in your bank account, it's called an overdraft. Now overdraft occurs when checks are written in excess of the cash account balance. So of course, as you don't have enough money, so what you do is you took out more money than you had in your bank account. So now, and that becomes a liability. So if it becomes a liability, it should be reported as a current liability. In general, bank overdraft should not offset against the cash account, so you don't offset it. So now if you have a bank account and you have a cash account, they don't offset, so you cannot for example, you have a bank, I'm just going to put it in here. So if you have a bank overdraft, what happens is, if you have an overdraft, you took out more money, and then let's say 200,000, you took this will be sitting as a liability. The company also has a cash account, and the cash account, they said they have a 400,000. You cannot, in other words, the saying that you cannot combine them. You should not offset it. So you cannot say that this is an asset and this is a liability, and you cannot say that your cash is 200,000. You cannot. So cash is reported separately, bank draft is reported separately as a liability. Now if it's in the same bank, then you are allowed to do that. If it's not in the same bank, you're not allowed to do that. So in this case, if it's at the same bank, then you're allowed to do this. But in this case, if you have two bank accounts, one bank account is a CIBC, the other one is a TD bank. One account you have a money, in this case you have 400,000. In the TD bank, you're overdrawn of 200,000. You cannot combine it. But if this TD bank was, instead of that, you had a CIBC, then you're allowed to combine it. It has to be from the same bank in order to combine it. If it's a different bank, one should be reported as an asset, the other one should be reported as a liability. So let's go further and see what else is saying. Now the next one is, we're talking about cash and cash equivalent. Cash equivalent defined as a short-term, highly liquid investment that are readily convertible to known amount of cash, which is subject to insignificant risk of changes in a value. So now anything that can be converted into cash quickly, that is called a cash equivalent. Typical example, these are some of the typical example of cash and cash equivalent. It is called the treasury bills, money market funds, and commercial ones. In other words, anything that can be converted into 3 months or less, that is called the cash and cash equivalent. Now, if you have a private, if you're working for a private company, they will be following ASPE standard. In that ASPE standards, any equity securities are excluded from the cash and from cash equivalent. Under IFRS, some equity instruments can be classified as a cash equivalent, such as preferred shares acquired within a short time of their maturity date. Now, cash equivalents are reported at a fair value. They're reported at a fair value. Now, the next topic we're going to be talking about is accounts receivable. What is an accounts receivable? You sold something on credit. A customer owes you money. If a customer owes you money, it will be sitting as an accounts receivable. In general, accounts receivable are claims that a company has against customer and other, usually for cash receipts in future. So accounts receivable means you are going to be receiving money in the future. So you are going to be getting cash in the future. They are reported as a short term. That's what we learned, but then we're going to also learn is that they can be reported as a long term, if you sold these accounts receivable to somebody to get extra cash. Now, under the when we're talking about receivables, the first one was accounts receivable. We can also have trade receivables. So accounts receivable, that we sold something on account. Trade receivables are amount owed by customers as a result of sale from ordinary operations. So normally when we think of it, when there is an accounts receivable normally don't pay any type of interest. That's why it's called an accounts receivable. Normally they will pay us within 30 to 60 days. Sometimes, depending on our credit policy, they can be paid in 90 days. But when we think about notes receivable, just the word note is a written promise. When there's a written promise, it's always going to have a interest rate built in it, and then there is a due date built in that. Now we could have two when we think of a non-trade receivable. Some are trade receivables and some are non-trade receivables. So, and what are some of the examples are non-trade receivables? Anytime you give an advance to the employees, they're called a non-trade receivable. So now the second one is delayed payment terms from the purchaser. So any delayed payment from the purchaser are non-trade receivables. Now the other one is as a corporation, we file our GST. If you are in Ontario, then what we do is we file HST. In that HST, what we have is we have two. We have a GST and we have a PST. In Ontario, so I'm saying it in Ontario, we have a PST which is 8%, and our GST is 5%, and then we pay 13%. Now, what we do is we file our GST returns. You could be doing a quarterly, depending, or you could be doing a semi-annually or annually, depending on what you're going to do. So in this case, if you are to receive money from the government, it's called a GST recoverable. If you're supposed to receive money from the government, it goes under the heading of non-trade receivable. Now the company files, now of course as an individual we file taxes in April. If you're self-employed, you will be filing taxes in June. But as a company, what we do is we also as a corporation we have to also file. Corporation also files taxes. If you are supposed to get a refund from your corporation taxes, then it goes under income tax receivable. So then goes under the heading of non-trade receivable. Now the company could also be receiving dividends or interest. If they have a cash and they put it into the market, they would be receiving dividend or they will be receiving interest, and they go under the heading of non-trade receivables. Amount owing by insurance company. So for some reason, what happens is that one of your building got caught on a fire. You put a claim through corporation, put a claim through the insurance company, and the insurance company is going to be giving company money, and then any money that is owed by the insurance company will go under receivables, and they will go under the non-trade receivables. Then the next one is loan receivable and notes receivable. Now, anytime you lend money to somebody, so it could be classified as a notes receivable or as a loan receivable. So investment in government debt Corporate bonds, convertible debts, and commercial papers are not receivable because they are held for trade. Now, how do you record your accounts receivable? Recognition and measurement standards. So how do we record our accounts receivable? Recognize an accounts receivable when the entity becomes a party to a provision of a financial instrument. Now, how do we record it? So when you sell something on credit, what you're going to do is debit the accounts receivable, credit your sales. Soon as you provide a service, and that's when you record an accounts receivable. That means that there's a contract between you and the other company. They owe you money. Recognize the receivable at a fair market value subject to discounts and interest elements. So they are recorded at the fair value. Whatever we sold this, in this case, we sold the our sales was $10,000. The value of your accounts receivable will be $10,000. So, but in this case, they are subject to discount. So what happens is, if your company's policy is, if they pay within 10 days, they get 2% discount. So this value are subject to, that means we are not going to get that $10,000. We're going to get less money depending on our credit policy. Going forward, they're saying recognize an accounts receivable when entity becomes a party to contractual provision of financial instrument. I explained it earlier. When one of the parties to the transaction has performed as per the agreement between the two parties. You perform the service, they owe you money. Once you provided them the services, you have to record it. So that's how it works. Then, similar to the way revenue is recognized in chapter 6, when we did is we gone through chapter 6, and we said that when to record the revenue. When a sale is recognized, when cash is received or accounts receivable is recognized, just like the word I said that. So now if you provide services on credit, then it is debit the accounts receivable and sale. That's when you record the accounts receivable. It could also be the on not a credit sales. It could be a cash sales. If it's a cash sales, as soon as you provide them the service, you record the cash either. So now in this chapter we're doing both. We're doing cash and accounts receivable. When you recognize the revenue, at the time you provide them the services, they will be providing you cash, or it could be on credit sales. Now, measure the receivable initially at a fair market value. So just the example we said, that if you provide a service and then it's for $10,000, you're recorded at $10,000. So now you could also have a 2% discounts. You also have to count for sales return or price allowance. So now, in other words, when we think about it, return, if the customer is not happy with the product that you sold or the service you provide them, you might have to provide them an allowance, or they might have to return the product. If they have to return the products and that you previously sold on credit, you debit the sales returns and allowance, and then credit will be your accounts receivable. So your credit will be your accounts receivable. Now, you have to think about it. I'm not talking about amortized cost. What we're going to do is we are going to talk about them in a later on when we do that. Recognize the impact of impairment or uncollectibility. So what happens is that if any customer that is not you know that the customer is not going to pay you. If the customer is not going to pay you, it becomes uncollectible. If it's uncollectible at the time you are aware the customer is not going to pay you, what you have to record it, as using an allowance method or a direct write-off to write this customer's off. So in this case, if you know that a customer, so for example, you have customer number A, you know that it's gone bankrupt. So if they're gone bankrupt, you're not going to collect the money. If you're not going to collect the money, what you're going to do is you're going to debit you're going to call it allowance for doubtful accounts. And what you're going to do is you're going to credit your accounts receivable. In this case, it's a customer A. So you're going to debit the allowance for doubtful account, and then you're going to credit your customer that is not going to pay. Now, loan and receivables are impaired. So anytime they're impaired means you're going to lose that customer. You have to, if they're, you have to record them. Anytime it's uncollectible or impaired, you have to report them on your both your income statement and your statement of financial position, both statements. Now, of course, impairment is important. So any impaired on trade accounts also are also called the bad debt or uncollectible accounts. Under the IFRS, the loss allowance is based on the lifetime expected losses. So now IFRS, if the customer doesn't pay you, that they are going to sit there for the lifetime. But in ensuring that reasonable estimate is made of the amount to the accounts receivable that is unlikely to be collectible under the IFRS based on a lifetime. Now, estimating uncollectible accounts, so that depends on your policy. Now, short-term receivables are reported at net realized value. What is a net realized value? You have an accounts receivable minus your allowance for doubtful account is equal to your net realized value. So accounts receivable minus your allowance for doubtful account is called the net realized value. Net realized value. In other words, allowance for doubtful account is a contra account and it's a contra account to the accounts receivable. Require estimating. Sometimes what we do is we estimate it at the end of the year. Management decide from their previous experience what percent of the customers are not going to pay you. So this is why it's called estimating the accounts receivable of the accounts or the amount that are expected to be uncollectible. The adjustment to the allowance account on the statement of financial position also impact the income statement. Just like I said that statement of financial position, which is your balance sheet. So when you write off anything at the end of the year, what are you going to do is you're going to write off something. If you're estimating it, you debit the bad debt expense and credit your allowance for doubtful account. This account is your statement of financial position account. In other words, this will sit on your under the current asset and this will sit under the expenses on your income statement. So when you're estimating any write-offs at the end of the year, the impact is going to be on your both financial statements. So now that depends on the company, what method are they using. There's three methods. First method is allowance method, the second method is percentage of receivable method. The third one is percentage of sales method. So we're going to be talking about all of them. Let's do the first one. First two are similar and the other one is a little bit different but not too much different. We talk about allowance approach. Management analyze accounts receivable at the end of every month and estimate the uncollectible amount. So now this is company's policy. If they say that they're going to be adjusting it every month, you have to do an adjusting entry every month. And if it's a smaller company, what they do is they don't do it every month. They do it maybe every 6 months whenever they're producing their financial statements, or they could be doing it once a year. Under the allowance method, allowance account is adjusted to the correct balance. Balance already in accounts in the allowance account must be considered. So since we are using an allowance method, it is called a statement. It used to be called balance sheet method. Now it's called a statement of financial position method. So so anything that is sitting in our allowance method, we need to adjust that at the end of the year. And our adjusting entry will be debit the bad debt expense and credit will be your allowance for doubtful account. When they're saying percentage of receivable, of course you're writing off percentage of what? Of receivable. It's exactly similar to your allowance method, but in this case we call this method is called an aging method. In other words, it used to be called an aging method. If it's an aging method, you depends on how long your accounts receivable is outstanding. Using the past experience, management estimate the percentage of outstanding receivables that will be uncollectible. So who decides that? The management. What they do is they estimate it. These are not actual, these are just estimates. Now again, same thing, allowance account is correct is corrected at the end of the period, balance already needs to be adjusted. Offset is recorded as a bad debt expense. You debit the bad debt expense and credit your allowance for doubtful accounts. Does not focus on matching principle. In other words, they don't focus on matching bad debt expense to the receivable. So these do not, they don't believe in percentage of receivable, do not believe in matching principle. So the next one is percentage of sales method. It used to be called a direct write-off method. When you have a direct write-off method at the month end or the year end, or when we're providing our financial statement, what you're going to do is percentage of the sales, you're writing off percentage of the sales. Management estimate the bad debt expense as a percentage of current month sales. So if you're recording an adjusting entry for the current month, you will look at the sales for the current month. Matches the estimated cost of bad debt to the sales. So what you're going to do is when you're using this method, it is sort of looking at matching the revenue with expenses, where the other two methods, they do not match your bad expense to the revenue. What we do is existing balance in the allowance for doubtful account, we ignore it. This is the method when we are doing the sales approach method or a direct write-off method, we ignore what is in our allowance for doubtful account. So what we do is we take our sales. We are going to do an example. We take a sales, whatever if you're doing this this adjusting entry and the monthly, so whatever your sales is, in this case your sales are 1 million, and then you write off 2% of it. What you're going to do is you're going to do an entry, whatever is the amount is, you're going to debit your bad debt expense and credit your allowance for doubtful account. So in other words, whatever the in the balance, whatever this number comes up, you debit that, and then the same number you credit it. In other words, you ignore what was in your allowance for doubtful account at the end of the year, or at the end of the month. Now we're going to talk about the first one, and we're going to see how we're going to do a journal entry. The first one we're talking about is the aging method. When you have an aging method, what the company look at it, how long their customers were, the age of these customers. So in this case, they look at it. In this case, first one is these customers haven't paid you, they're within 61 days. So you could have some customer haven't paid you between 61 to 90 days, and sometimes some customer come under the second one, and some customer comes under the 120 days, and sometimes we have 180 days. And when you know that those customers are not going to pay you if it's 180 days, unless the only way to collect from them is providing them discount. Now, if you were to look at in this case, we are going to look at this example. So this is the example. So in this case, the company estimates how much their write-off is going to be. The uncollectible is going to be. Prepare an analysis to estimate uncollectible accounts for Wilson and Company. So in this case, Wilson, what happens is it's a company, they have an accounts receivable. If they have an accounts receivable, what they're going to do is now they have some customers. I'm just going to put it so I could show you this. So now you have different customers. So these are their customers. So in their customers, they have 460,000 worth of accounts receivable that are to be collected within 161 days. So they're sitting that there as outstanding. So if they're sitting as an outstanding, that's the amount sitting as a outstanding 460,000, and it is under the 61 days. So these are the two customers. They are sitting under the 61 to the 90 days. The 14,000 sitting under 91 to 120 days, and 55,000 sitting as 120 days. So what we are going to look at is the management decide their estimate. So what they did, if they look at it, they look at their previous experience, and they're saying that from the previous year, they know that 4% of the customers are not going to pay them. If they're not, will be uncollectible. You're going to take the 460,000 multiply by the percentage estimated to be uncollectible, give you 18,400. So then the 18,000 was going to be was outstanding for the 61 to 90 days, and then we multiply by the percentage estimated to be uncollectible. That gives you 27,000, and then the 20%, then the 25%. Altogether, we know at the year end, we know $37,650 dollars worth of accounts receivable estimated to be uncollectible. So what we needed to do is, how we're going to do the adjusting entry. What we need to do is, first thing we needed to look at it, since we're doing an aging method or an allowance method, we're using this as an allowance method. So what we needed to do is, we needed to find out what was my allowance for doubtful account balance was. In this case, this is example 7.4a, shows how Wilson's companies would reflect the estimated uncollectible account on their financial statement. So you had an accounts receivable. In this case, they had an accounts receivable. If I look at it, their accounts receivable balance was 547,000. So that was my accounts receivable. What they did is, we estimated at the end of the year, my allowance for doubtful accounts will be uncollectible. So what they had to do is, they had to do an adjusting entry. They did not show us an adjusting entry. So they did show us an adjusting entry. So in this case, what we're looking at it, they don't have any balance in my allowance for doubtful accounts. So that what we do, they will do an adjusting entry. So what will be the adjusting entry? They will do a debit the bad debt expense, and credit will be your allowance for doubtful account, and that will be 37,650. What we're doing is, we're accounting for it that allowance for doubtful accounts has a zero balance. So there was no balance. What we needed to do is, we put it in at 37,000. Once we post that entry, the balance in my allowance for doubtful account will be 37,650. Your accounts receivable account will be whatever the balance in my accounts receivable minus your allowance for doubtful account, equal to your net realized value of your accounts receivable. So that's the net realized value. But things could change, right? If there was a balance in this account, your entry will change, because we're using an allowance method. In this case, what happens? So in A, we are showing it that your allowance for doubtful account did not have any balance. What if there had a balance in there? So the next one is, we're saying that, what if there was a balance? Assume the allowance account already has a credit balance. So in this case, the balance in this account was a credit balance. The balance we need when we did the balance we need is 37,600. The balance we need under the allowance is 37,650. If that's the balance we need to do an adjusting entry. When we do an adjusting entry, we take the difference between those two. In this case, the difference between those two, 18,850. Now look at it. So this will be my adjusting entry if there was a balance in there. My entry then will be difference. You're going to do a debit. What will be your debit? Bad debt expense will be a debit of 18,850. And what you're going to do is, you're going to credit the allowance for doubtful account, and that will be 18,850 if the balance you started off with is a credit balance. But that's not always happen. Sometimes you could have a debit balance too. So I think the next entry is, what if there was a debit balance in your allowance for doubtful account? So now in this case, if we did the entry with a credit balance, what if we had a debit balance? In this case, they started off with a $200. We need a balance of 37,650 because we did a calculation of it. Then if that's the case, what you're going to do is, we need a credit balance. You're going to be adding it. Your adjusting entry will be 37,850. So this was a debit balance. You're going to be putting a credit entry by the look of it. What you're going to do is, you're going to do an allowance for doubtful account of 37,850, and what you're going to do is debit your bad debt expense. So that your bad debt expense will be 37,850. How you arrive to the number does not change, 3760, but the balance in that account matters when you're doing an allowance method. Now the next one, what we're going to look at is that the percentage of sales approach means it's a direct write-off. What the company decides is they will tell you what the estimate is. Example 7.5a, Doctoral Corporation estimate 2% of every month's net credit sales will be uncollected. What journal entry you will be doing? So in this case, is that what journal entries would be required during the year if net credit sales are 400,000 annually. So what you're going to do is, if you're now we are doing a direct write-off, we're going to take our sales, and then what we are writing off is 2%. In this case it is 8,000. So it does not matter what my balance was in my allowance for doubtful account. It does not matter. All we're doing is whatever number we calculated, we debit our bad debt expense and credit my allowance for doubtful account. So that's the difference between the both methods. Is one, we do a direct write-off. This is whatever the percentage is, we write that off. And the first one that we did was aging method or allowance method. We look at it, what is the balance in that account. In this case, if we look at it, management estimate the uncollectible account at the year end are 9,900. What journal entry should Doracle make if the balance in the allowance for doubtful account is 7,500 before the adjustment? So now what they're doing is, in this case, they're saying what balance will be reported if there was already had a balance sitting there. So in this case, if they were using an allowance method, there was a balance sitting there, then and what balance will be. In this case, what they're saying is management estimate that the uncollectible account at the year end is 9,900. What journal entry they should make if the balance in the allowance for doubtful account is 7,500. So if there was a balance of 7,500 and they needed to write something off, and what they said is they want the 9,900 balance in their allowance for doubtful account. And then what they will be doing is they will be doing an adjusting entry. In this case, their adjusting entry will be for the sorry, I did it the other way around. Now I put the other way around. So the balance in your allowance for doubtful account had a 9,900, and then what the balance they need is they need is 7,500. If they need the balance in the 7,500 before the adjustment, no, I did it, I had it right before, but I didn't realize. Saying that management estimate the uncollectible account at the year end is 9,900. So the balance we need is 9,900. The balance we started off with was 7,500. I was doing it right. The balance, the adjusting entry we will be doing it is 2,400. So in this case, it is a combining approach. It's a combining approach. So what they're using it at the end of the day, they're using the allowance method when they're looking at the allowance count. That means they tell you, they're saying that they want this balance at the end of the year. If they want it could be depending on, it's not dependent on the sales, they just want that balance. If they want that balance, you need to look at it, what's the balance in that account is, and then you do your adjusting entry according to that. It's not a called percentage of a sales approach. It is, they're saying it, in this case they're telling you what the balance they want, and then you do your adjusting entries for the difference. So what happens is sometimes a customer decide to not pay you. Another, how you're going to know? You're going to get a notice from the customer saying that we're unable to pay the balance in our account. So when that happens, when a customer, a specific customer account is determined to be uncollectible. If you know a customer A is not going to pay you, you have to write it off. How are you going to do a write-off? Means you're going to, whoever the customer is, you're going to debit your allowance for doubtful account and you credit your accounts receivable. What you're going to write off is whatever the amount they owe. That's what you're going to write off. Now if you wrote off somebody, a customer previously, and now they decided to say that, with the goodness of their heart, they said that, oh, the company started doing well, and we would like to pay the money that we owed you. So in other words, first that you write it off. The second thing happened is you have to reinstate them, and you have to collect the payments. So of course, this customer wasn't going to pay us, so we wrote it off. But now the customer decided to pay us. What you're going to do is first you have to reverse what you did before, and then what you have to do is receive the money, because we have nothing sitting in the accounts receivable. How are we going to collect it? First you have to reverse. How are you going to do a reversing entry? Entry is the opposite of the entry that we did before. You debit the accounts receivable and credit the allowance for doubtful account. Once we reverse the entry, now we can collect the money from this customer. When you collect it, debit the cash and credit your accounts receivable. Now what we're going to do is we're going to go back. Now we're going to do a direct write-off method. So when you have a direct write-off method, now what you're going to do is you just write off a direct write-off, debit bad expense, credit the accounts receivable. When you think of a direct write-off, is that what you're going to do is you're not using an allowance method, you're using a direct write-off method. A customer is not going to pay you. If the customer is not going to pay you, what you do is for example, if the name of the customer is my name, I'm not going to pay you because I don't have the money to pay you. So I send you a memo saying that I'm not going to pay you. So when that happens, if the company follows a direct write-off approach, they will debit the bad debt expense and they will write off the credit accounts receivable. So now what they do is they're not looking at any allowance method. So now I start working at, let's say I start working, and then I know that I am able to repay them. So if I'm able to repay them, what I'm going to do is then when I decided to pay them, you debit the cash account, and then credit will be uncollectible accounts recovered. So it will be called uncollectible accounts recovered. Means a previously recorded bad debt expense is now recovered. Now looking at the second one, when we talk about the receivable, and in this case we are talking about notes receivable. It's a written agreement. In that written agreement, you know how long this note is for and what is the interest on that note. So that's what happens. So now there's two type of notes when we think of it. One is called an interest bearing, and the other one is called a zero interest bearing, means non-interest bearing notes. So let's do the first one. When they think of an interest bearing note, interest is visible to you. So that's what happens. So let's do an example with the interest bearing note and non-interest bearing or zero interest bearing note. On March 14, an accounts receivable of 1,000 is exchanged for 6% and 6 months note. So what you have is you have on your balance sheet, on your statement of financial position, you have an accounts receivable, and the accounts receivable is $1,000. So the customer is sitting as an accounts. We needed to collect money from that accounts receivable, sitting as a credit. So what they did is the company that owed you money, they don't have the money. They said that instead what we could do is we can give you a notes receivable. Means you can take that note to the bank and get the money with the interest. So it's called the notes receivable. So what happens is, now if this customer no longer owe you money, because instead of them giving you cash, they given you a note. So on the 14th, what you're going to do is you're going to debit your note receivable, because now you received the note, and you're going to credit your accounts receivable. Now what we have is they given us this note for 6 months. So when the 6 months is going to go by, what we're going to do is we're going to take this note to the bank, and we're going to collect all the money. So we're going to collect the interest and the money they owed us. So in this case, the note was 1,000, the interest rate is 6%, and it is for 6 months. So what we're going to do is we're going to collect the interest of $30, and our note